So you're a person and you want stuff. Food, a place to live, maybe a new phone that isn't cracked. Here's the catch. There's not enough of everything to go around for everyone who wants it. And that single fundamental problem, that's why the entire field of economics even exists. Okay, so let's take this giant topic and break it down into pieces we can actually wrap our heads around. Here's our game plan. We're going to start small, with you and the choices you make every day. Then we'll zoom out to see how millions of those choices create what we call markets. After that, we'll figure out how we measure an entire country's economic health, meet the big players who make it move the rules, and see how the whole world trades together. And finally, we'll get into why our wonderfully weird human brains are maybe the most important part of the whole equation. All right, let's dive right into part one. This is the big one, the absolute core idea that the whole study of economics is built on. It all comes down to one word: scarcity. It just means there isn't enough stuff to satisfy everyone's wants. I mean, think about it. If we had an infinite supply of everything, we wouldn't need economics. But we don't. So we are constantly forced to make choices about who gets what. And economics? It's really just the study of how we all make those choices. And every single choice you make has a hidden cost. Right now, by choosing to watch this, you gave up the chance to do literally anything else, like, say, watching hilarious cat videos. The value of that next best thing you gave up, that's called your opportunity cost. Let's hope this explainer is the right choice. Now, here's where it gets really interesting. This whole idea of opportunity cost is what makes trade possible. You don't have to be the absolute best at something to have an economic role. Nope. You just need to have a lower opportunity cost, meaning you give up less to produce it than someone else does. This is called comparative advantage. It's why it makes sense for people and even countries to specialize in one thing and trade for everything else. It actually makes everyone better off. Okay, so let's move on. We've got our individual choices down, but what happens when millions of people's choices all crash into each other? Well, that's where we get markets. So what is a market? It's really just any place where buyers and sellers get together. And it all runs on a super simple principle. People respond to incentives. If a new video game is $10, lots of people will want it. That's demand. If it's $500, lots of companies will want to make it. That's supply. And somewhere in the middle, those two forces meet at what's called the equilibrium price, that sweet spot where the number of games for sale perfectly matches the number of people who want to buy them. But trying to trade, say, your pet goat for some Wi-Fi service, that's just not very efficient, is it? So to solve that problem, we invented money. It serves as a medium of exchange, a unit of account, so we know what things are worth, and a store of value. It's basically the oil that keeps the complex machine of the global market running smoothly. Now, here's the wild part. Markets manage to coordinate millions of people without anyone being in charge. Everyone just acting in their own self-interest creates this surprisingly organized system. The economist Adam Smith called this the invisible hand. It's not some magic force, it's just the power of prices. A high price for coffee sends a signal to farmers. Hey, plant more coffee. It tells drinkers, maybe switch to tea. A low price does the exact opposite. Billions of these signals guide resources to where they're needed most, all on their own. Okay, so markets are great. But how do we know if a whole country's economy is healthy or sick? For that, we need to zoom way out and look at the big picture. The main tool we use is gross domestic product, or GDP. It's a fancy term for the total value of all the finished goods and services made in a country over a year. The easiest way to think about it is just adding up all the spending. So you've got C for consumption, that's all the stuff you and I buy. I for investment, what businesses spend on things like factories and tech. G for government spending. And finally, net exports, what we sell to other countries minus what we buy from them. Add it all up, and you get GDP. But here's the thing. GDP almost never grows in a perfect straight line. Economies tend to move in cycles. When things are going great and the economy is growing, we call that a boom or an expansion. When it starts to shrink for a while, that's a recession. Now, we don't just have to ride out these economic ups and downs and hope for the best. There are some very powerful players that try to steer the ship. Let's talk about the rule makers. The biggest player is a country's central bank. In the US, that's the Federal Reserve. Their number one tool is the interest rate, which is just the cost of borrowing money. If the economy is running too hot and prices are shooting up, that's inflation, the central bank will raise interest rates to cool things down. If the economy is sluggish, they'll lower rates to get people borrowing and spending again. The other major player, of course, is the government itself. It spends a ton of money on things like roads, schools, and defense. So where does all that cash come from? Well, mostly it comes from us through taxes on our income, on company profits, on things we buy, and on property. But what happens when the government spends more than it brings in from taxes? It has to borrow the difference. And when you add up all that borrowing, year after year after year, you get the national debt. For the United States, that number is now over $34 trillion. And as you can imagine, what to do about a number that big is one of the hottest debates in economics. So far, we've pretty much stayed inside one country's borders. But we all know the modern economy is a global affair. So let's zoom out one more time and see how the world trades. And this brings us right back to that idea of comparative advantage. This little table explains it perfectly. To grow 1 ton of corn, Brazil has to give up making half a ton of coffee. But for Canada to grow that same ton of corn, it has to give up a whole ton of coffee. Brazil has the lower opportunity cost for growing coffee, right? So it makes total sense for Brazil to focus on coffee, Canada to focus on corn, and then they just trade with each other. By specializing, they both end up with more corn and more coffee than if they tried to make everything themselves. But of course, trade isn't always completely free. Governments sometimes try to interfere to protect their local industries. They use tools like tariffs, which are just taxes on imported goods, or quotas, which are limits on how much can be brought in. Now, this might help a few local companies, but it almost always ends up making things more expensive for the rest of us. And now for our final section. We've looked at big systems and cold numbers, but let's not forget what drives all of it: people. And people, well, we are delightfully complicated creatures. You see, for a long time, traditional economics sort of assumed that we're all perfectly rational robots who always make the optimal choice. But a newer field called behavioral economics has shown that we are, in fact, predictably irrational. We hate losing $20 way more than we enjoy finding $20. We'll sit through a terrible movie just because we paid for the ticket. We'd rather have $5 today than $50 a year from now. And yes, we absolutely panic buy toilet paper just because we see everyone else doing it. And these very human quirks are what shape our biggest economic systems. At one end of the spectrum, you've got capitalism, which is driven by private ownership and profit. It's an unbelievable engine for creating new things, but it can also lead to huge gaps between the rich and poor. On the other end, you have socialism, which focuses more on collective ownership and equality. Great for fairness, but sometimes not so great for motivating people to innovate. The truth is, nearly every country today is a mixed economy, trying to find a balance somewhere in the middle. Which brings us to the end. Every single economic system, every government policy, and every personal choice is really an attempt to answer 3 simple-sounding questions. What are we going to make? How are you going to make it? And who gets to have it when we're done? Because of scarcity, there are always trade-offs. And so far, nobody has figured out the perfect answer. The real question is, will we ever?